found, including you. You will never change. Great on you. My God still say, He's still heals every word I pray. He still heals, He still restores. Jesus reigns forevermore. My God still saves, He still heals every word I pray. He still heals, He still restores. Jesus reigns forevermore. You're welcome. Good evening, good afternoon, good morning, depending on where you're watching me from today. How are you doing? How is your day being? How is your day going? I'm just going to wait a bit. So, send a request. Whoa. How is weather on your side? I've not been on live for about 2 days now. Shine 20256. I see you sent a request. Did you want to ask question? Do you want to join? I see you sent in your request. Should I bring you up? What God still save. He still hears every word I pray. Okay, I'm bringing you up now. Hello, Shine 20256. How are you doing?
I'm good. How are you?
I'm doing well. Nice to meet you.
Nice to meet you too.
Yeah. How was your day? We are in the same line. Oh, personal finance. Yes, we're in the same line. You can come and share your thoughts with us this evening. You're welcome. Today is Friday. It's always like mostly freestyle day, ask question and answers, share your experience with us. If you want to come live, yeah. If you want to come up, you can send in your request. So Shine, how can I help you today? Or do you want to share? You want to share with us? Shine is on Instagram. You're welcome on YouTube. And you're welcome on TikTok as well. Shine, are you still there?
Yeah, I'm still there. Sorry, I'm just about to drive.
Oh.
I'm just learning. And learning. the more I attend this session, the more I get more encouraged and get more enlightened. Yes. Yeah.
It's good to learn, but at the same time, you can just take the first step because that will give you the more confidence. You have more confidence by the time you take your first step. You see how the market is going. You can start with any amount, very low amount, right? Even if it's $20, $10, just see what the market is doing. It will encourage you to want to put more in the market. You got yourself what? Oh, let's clap for you. So I'm going to ask you, how did you feel when you got that your first dividend? How did you feel? Yes, that's always the feeling. Like I got my clients or my student, they used to say to me, "Oh, I just got my first dividend." I didn't really know. Someone even told me I got $118 coming from somewhere. I said, "Well, I believe it's dividend that is being paid to you because you didn't sell your shares, right?" And I'm glad that you got your first dividend. You can see that at least your money is already working for you in the market. Oh, I think I lost. Hello, good evening. Welcome to today's live. Today is Friday. I'm still in the evening where I am, depending on where you're joining us from. It might be morning, it might be evening, it might be early in the morning. You're welcome to today's live. Omoluabi, you're welcome. Hi. So this evening, today is Friday as usual. It's always like a freestyle day because it's weekend, right? And we're getting ready for the weekend. So we're going to be answering some questions. And after I answer some questions that I have here, then I dive into the teaching proper. Okay. So how do I don't know how to do this then? Uh, So you're welcome this evening. And this evening, we're going to be looking at the stock market. Any question and answer that you have, you can either send your request to come up and ask your questions, or you can leave it in the chat and I will try as much as possible to answer the questions. So, like I said, we're going to be starting with some question and answers that I've seen some people send into my DM, and I like to answer them on live broadcast like this. But after then, they will teach you the steps for you to start investing in the stock market. And we can just see Shine share a testimony from Instagram where she says she has already started and she has gotten her first dividend, right? And that is the most important thing. You starting, don't just keep learning. Take that very first step and get your feet dirty in the market, right? So, going into the questions today, what is our first question? Where are the questions? Dun, 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 dun. Okay, so our first question says, I have about $2,000 saved right now, and I am not sure if it's enough. How much should I have in savings before I start investing? That is our first question. I'm going to repeat the question. The question says, I have about $2,000 saved right now. I am not sure if it's enough. How much can I have in my savings before I start my investing? Is there anyone that wants to answer that question for us? Is there anyone that wants to answer that question for us? I have about $2,000 saved right now. How much should I have in my savings before I actually start my investing journey? Okay, so like I always say, you don't need to have much in your savings before you start your investment journey. If you already have $2,000 saved, the first thing you want to note is it enough for my emergency fund? And I've told us how to calculate emergency fund, right? I'm going to repeat it in this call this evening. So if you want to calculate your emergency fund, you're going to start with your monthly expense. What is my monthly expense, right? And when I say monthly expense, I mean your wants. Sorry, I mean your needs. So your needs are the things that, your basic things that you need every month that you cannot do without every month, e.g., mortgage, rent, your car payment, your school repayment loan, the likes, insurance, right? All those are your needs. So you want to calculate your needs. What are your total needs for the month? So let's say your total needs for the month is 1,500, right? Your total needs for the month is 1,500. Then you want to tell yourself, as in how many months do I want to set aside? Basically, people say set aside 3 months, some say 6 months, some say 12 months, right? It all depends on you. But I love to say start with the minimum, which is 3 months. So let's say you want to put aside 3 months of your emergency fund. We've calculated our needs. Our need is 1,500. So we're going to multiply it by 3 to say, in case if anything even happens, you lose your job, you can't do anything, right? You have funds that will comfortably cater for your needs for the next 3 months. So that means we're going to be looking at 4,500, right? We're going to be looking at 4,500. So for this question that says, I already have $2,000 saved, I don't even know if it's enough, right? This is how you know if your emergency fund is enough, if the money you have in your emergency fund is enough. Now, let's say I'm using the scenario of this person. This person, maybe the emergency fund is actually 4,500, which is 4,500. And they want to save they already have $2,000 saved, right? That means what they need for their emergency fund right now will be around 2,500. Now, I tell you that when you want to start investing, if you've not completed your emergency fund, you've not finished saving your emergency fund. Remember, emergency fund, we put it in high yield savings account, we put it in savings account, we put it in a liquid position where we can easily say, I need this money now, and it comes out, right? That is where we put our emergency fund. We don't put our emergency fund in high risk investment, right? So now for this person that says I already have $2,000, that means they already have a portion they are saving from their income. So let's say for this person that said they already have $2,000, let's say the portion of their income they are saving is 10%. So maybe every month from their income, they put 10% into their savings account because they are saving their emergency fund. If this person wants to start investing, because I like to tell you that as you're saving, also be investing because you're making your money work for you. We just had Shine's testimony, right? You're making your money work for you, right? So from the 10% you're putting aside in your savings account, you can say from this 10%, I'm going to be putting 7% in my savings account so that I'm able to achieve my emergency fund on time. The remaining 3%, I'll be putting it in the stock market. I'll be investing the remaining 3%. So you can see that while you're building your emergency fund, right? While you're building your emergency fund, you're also doing what? You're also investing. It is good for you to do both side by side. But if you've not fully saved your emergency fund, then the percentage you're putting aside for your savings and investment, put a chunk of it in your savings while the remaining portion goes to your investment and make your investment, your money start working for you. So that by the time you're done with your emergency fund, you're pushing everything to your investment account. You're already in the market. You've tested the market. You know what the market is. You're already in that market. You're already a player in that market. And that's the answer I'm going to be giving to this person that says, I already have $2,000 saved. I'm not sure if it's enough. I've told you how to calculate your emergency fund. Your monthly needs, not your wants, your needs, what you cannot do without. Multiply by the number of months you want to use, as you want to keep aside. 3 months, 6 months, 12 months, 24 months, it all depends on you, right? And that is what forms your emergency fund. If you have questions, you're welcome in on TikTok, on Instagram, on YouTube, you're welcome in. If you have questions, please, you can either send in your request to ask your question, or you can put a question in the chat. This evening, we're going to be looking at the stock market, how you can start investing in the stock market with as little as $10, as little as $5, as little as $50. But before we go in, I just have some few questions that I'm going to be answering before we dive into how you can start investing. And that's the first question we took. So we're going to be looking at another question. So this question says, every time I think about investing, I get scared of losing money. How do I keep investing? No, not that one. How do I get over the fear? That's the question. It says, every time I think about investing, I get scared of losing money. How do I get over the fear? Is there anybody that wants to answer that question for our friend? He wants to start investing, but each time he's always scared of putting their money in the market. How do they get over this fear? How do you get over the fear of losing money in the market? Because the market would always do its what? It will always do its thing, just as we always say. The market would always do its thing, right? But how do you get just a minute. How do you get over that fear? The way you get over the fear of losing money in the market is, number one, before you even start buying those stocks, make sure you're buying good stocks. Make sure you're buying good stocks. You're looking at the analysis. The truth is there will always be ups and downs in the markets. That's the simple truth. But if you buy good stocks and you're not selling, you're not doing panic selling, then you will make money from the market. You will not be losing money in the market. the first question I want to ask is, how do you lose money in the market in the first place? Because everybody think, oh, you can lose money in the market. But how do you really lose money in the market? The way you lose money in the market is when you sell your stock at a loss. So even if the projection is showing on your on your app, that okay, I bought the stock for $1,000. When the rate is going right now, if I sell, I'm going to be making $900. That means already it's showing me that there is a unrealized loss of $100, right? If I do not sell that stock, I have not made that loss. It's until I decide to sell that stock, that is when I make the loss, right? Until I decide to sell that stock, that is when you actually realize that loss. What is showing you as a projection, as a negative on your app, it's not the loss you've taken. It is when you decide to sell that stock. So one way to get over your fear is when you see that, oh, this stock, I bought it $1,000, but it's showing me that there's already a 10% loss on the stock. Don't sell at that point, except if it's not a good company, because most times if a stock, as in if there's a drop in the market, if there's a dip in the market, most times the stock would bounce back. If it's a good stock, it will bounce back. That is why you always see the wave, because each time you check the graph, you will see the wave, right? There's always an up, there's a down, there's an up, there's a down. That is showing that it will dip, it will bounce back. So if you don't sell at that time when there is a dip, you have not made that loss. So it's a mindset thing. Most people, once they see the dip, oh, I bought the stock for 1,000. It's already showing me that if I sell now, it's 900. What do I know that it's going to do tomorrow, right? And they sell out of panic. That is when you make that loss. But if you do not sell it, you do not make the loss, because there will always be a dip in the market and there will always be a bounce back. So for you to sell, wait for it to bounce back. And with the exception of, okay, maybe if you hear that, oh, the company is going to be liquidated, fine, then you might want to take your loss and move on, right? But if you buy good stocks, if you buy good ETFs, when there's a dip, it will always bounce back. So you wait for it to bounce back. Even when you're buying a stock, maybe you bought a stock out of emotion, right? You didn't really do your due diligence before you bought the stock, and you're seeing a dip in the market. You can decide to say, I'll wait for it to bounce back. And once it bounces back, I'm going to get out of the market, right? And there's a way you can even set it on your app. You can do a limit sell on your app, put a date for, you can set it for 90 days. That means you set the price, you want to sell it for 90 days, and the system will do all the work for you, right? So that is how you get over your fear. You don't sell when there's a dip. Just have it at the back of your mind. I don't sell when there's a dip. That is how you get over your fear, and make sure you're buying good stocks and good ETF into your portfolio. Okay, so let's look at another question. You're welcome on TikTok, you're welcome on Instagram, on YouTube, you're welcome as well. If you have question, you can drop it in the chat, or you can request to come up to ask your question. I'm not sure how to drop this person. You're welcome. So I'm going to be answering another question. Okay, this question says, I'm new to investing and feel overwhelmed by all the apps out there. What platforms are good? What platform are actually good for beginners? Honestly, I don't know the country you're in that you're asking this question from. And I know that there are a lot of, oh, thank you so much for the ask me, Emperor TJ. So I know there are a lot of apps out there, and I know it could be overwhelming, just like you said. So, but the thing is, look for, if you're as a beginner, there are so many beginner-friendly apps. What the first thing you're looking for is an app that will not charge you for investing. You're looking for a zero commission app, because the little money you're investing or the big money you're investing right now, you don't know what commission to take it off you, right? So you're looking for a commission-free app. That is number one. Number two, you're going to be looking for a beginner-friendly app. You're not trading, you're investing, right? So all you're doing is you're buying, you're holding it for a period of time, and you sell. You don't need a complicated app. So I'm going to be giving you some samples of apps that you can download depending on the country you're in. Like I said, I'm not sure the country you're in. If you've added your country, maybe I would have been able to tell you, okay, do this app, use this app and the other app. But if you're in Canada, for instance, you can start with World Simple. World Simple is very beginner friendly. A grade 6 would use World Simple comfortably, right? If you're in the US, there's Robinhood, there's Fidelity. These ones are beginner friendly. If you're in UK, trading 212. If you're in Africa, there's Bamboo, there's Chaka, and the likes. So those are the ones you're going to be looking for. But the most important thing is you're looking for an app that is zero commission, because you don't want to start paying on the investment you're doing, on the trades you're taking. You don't want to start paying on them. That is how you look for apps, right? That is how you look for apps. Just stick with one. You don't need more than one app to start investing. That's all you need. One app for you to start investing. You don't need more than one app to start. Okay. So this question says, I'm just trying to see what the question is. It says, okay. I keep hearing that real estate builds wealth faster than stock. I am confused. Is real estate better than the stock market? That's a good question. I keep hearing that real estate builds wealth faster than stocks. I am confused. Is real estate better than the stock market? Who wants to answer? Does anybody want to answer for us? Okay. So real estate and stock markets, they are two different things, right? They are different types of investments. Now, there are different types of investment. There are two different things. Either one, both of them appreciate in value. When you look at real estate, you look at stocks, they both appreciate in what? In value. Both of them require capital, right? You want to buy real estate, you want to go into real estate, you need capital to go into real estate. You want to buy stocks, you need capital to go into stocks. Now, if your purpose is to own physical property, you want to own physical property, you want to manage the property, you want the property to be in your name, you want to have 100% control over the property. Remember, I said if your goal, right? You want to have 100% control over the property, then you'll be looking towards real estate. But if your aim is, I want to make money from investing, I don't mind not having the property in my name. I don't mind not having 100% control over the property. I don't mind not having control over the tenants of this property. Then you can look into stocks, because you can buy real estate stocks in the stock market. So it's not just companies that you can also buy stocks of real estate in the stock market. And that's the difference. The difference is one gives you control, the other does not give you control. Physical property will give you control. You control the property is in your name, you control the tenants, you have 100% shares in that property. But when you go into the stock market and invest in real estate property, what happens is you don't have 100% control, right? You can only control to the amount of shares that you have. You have other stakeholders, you have other shareholders that come together to make decisions on the property that you all own in the stock market. Now, which one grows faster? Which one grows faster depends, because remember, when you're going into real estate, right? When you're going into real estate property, remember the capital you're contributing into the real estate. If you can put that same capital in the stock market, right? If you can put that same capital in the stock market, in real estate investment trust, it might grow at par. It may grow at par, because there are some real estate trusts that will pay you 7%, 8% dividends, right? 7%, 8% dividends. So let's say you invest $100,000, for instance. Let's say your down payment for your house is $100,000, right? Because that is how you know if you're really making money from the market. You invest $100,000 to buy a property. The property is worth 400. Let's say it's worth 400. Remember that you took a mortgage of 300, which means you'll be paying back. So let's say every year your returns on this property, after your expense is 7%. 7% on 100 on a property of the property is 400,000. Can you even make 7%? I'm not sure. But let's say 7%. 7% of 400,000, 10% is 40,000. 7% would be 5% is 20,000. Right? Yeah, 5% is 20,000. That means 7% would be about 25K. So 7% will be about 25 to $28,000. $28,000. That means that's about 2K, which I doubt. That you'll be able to make 7%. I doubt it. That's about 2K monthly after your expenses. I really doubt it. But you can put this same $100,000 in the market and buy real estate investment trust and be getting the 7%, because there are a lot of good real estate investment trusts that will pay you about 7%. That means you'll be getting $7,000 every year. You'll be getting $7,000 every year from your investment. But the only thing is you don't have control over this property. You are just an investor. You have other people that are also investing in that same property. And this $7,000, you can decide to use to invest it into the market to buy more shares, or you can decide to withdraw your $7,000 just as you will have in your physical property. Now, this $100,000 will keep growing in the market. So if you intend to hold your physical property for 20 years, then you must intend to hold this $100,000 for 20 years as well, to be able to know, to be able to determine if actually the value of the property would appreciate faster than the stock market. Because at times, if you calculate it, it might not appreciate. The value of the property as a physical real estate might not grow faster than the stock market. By the time you consider everything, your overhead, your time, and the likes, right? You consider your overhead, the time you use in maintaining that house, the time you use in looking for tenants and the likes. By the time you put all those into cash consideration, it might not appreciate faster than than the money in the stock market. But these are the things you need to do. You need to break it down to be able to say, okay, the physical property appreciates faster than the stock market. Because like I said, there are some properties, there are some stocks that will do. If you buy a real estate stock that is doing maybe, even if it's 5% returns every year, 5% returns every year, 5% return on your 100K, that would be 10% is 100,000, that would be $5,000. Right? $5,000 aside from the dividends you have taken for that year. If you do 7% dividends plus a 5% return, that means every year you'll be getting about $12,000 in return plus dividend. The question is, does your house appreciate about $20,000 every year after you've taken into consideration your repayments plan back to as in your repayments plan? Will you get $12,000 back every year? So those are the things you need to look. Nobody will tell you, oh, it's true, the building will appreciate faster. It all depends on what you want. What is your goal? What is the end goal? If you want control, you want physical property to be in your name, yes, you want to deal with the tenant, then go with a physical property. But if you know you can outsource that to someone else and all you want to do is just collect your dividends and make your returns from the market, then you go into the stock market. It all depends on you. But the growth most likely will be at par, or even if it's not going to be at par, it will be slightly higher. However, by the time you consider your time, you account for your time, the time you use in managing this property, your credit score that you have to maintain, all the likes, then you might see that investing in the stock market might be better than you having a physical property. However, it's always good to have physical property as part of your investment. Like I said, they all serve different purposes. Emperor TJ says, please tell us disadvantage of real estate stock. Is there a disadvantage? I'm just thinking. The only thing I see is you don't have control, right? Because physical real estate stock is just like the way you trade normal stocks, the way you trade normal companies, right? There's no difference. The only difference is real estate stocks, their specialization is in real estate. They don't do any other thing other than real estate. That's the only difference. But everything that is applicable to every other stocks is the same thing. So if there's a dip in the market, there's a dip in the real estate stock market. If there's a bounce back, there's a bounce back in the real estate stock market. Even physical property, there are times that there are dips as well. There are times that there are dips as well. The only disadvantage I see is at least you monitoring the stock to know, okay, this is when I need to say, okay, this is when I need to sell my stocks. But aside from that, I don't really see any disadvantage in real estate stock. The only thing I see is the stock, you don't have physical, you don't have control over it, right? It's not like your physical property that you can just say, oh, I don't want to put anybody in this house. I don't want to employ these people in this house. What about the loss? The thing is, the stock markets, like I said, there will always be deep. There will be a bounce back. Now, for you not to take loss, when there's a dip, don't sell. Right? When there's a dip, what I mean by a dip is when the market is down. That's what I mean by a dip. So let's say I bought this stock for $10 now. I bought a real estate stock or any stock for $10. Maybe after 3 months, the stock is selling for $40, which is very rare though. It's selling for $40, right? That means it's gone up. Now, after 3 months, maybe in month 3 months and 2 weeks, 3 months and 2 weeks, there's a dip because maybe some people are taking profits and the likes. There's a dip in the market. Now the stock is selling for from, okay, let me use $20 because I don't want to believe it will crash that way. Okay, from $10 to $20 in 3 months. That means it's showing that you made a gain, unrealized gain, because you've not sold that stocks, right? Unrealized gain of $10. Now, let's say month 3 months and 2 weeks, there's a dip in the market. This stock goes to $15. $15. Do you know that you've not made a loss? Right? You still have an unreal, because remember, your initial price for this stock is $10. Right? So even if you decide to sell when there is a dip, instead of you selling at that $20, you can sell at $15 and make your $5 gain. But let's now say there is a very huge dip. This stock goes to $8. Then your system will tell you there's an unrealized loss of $2, right? Because you bought it for $10. Now it's being sold for $8. If you decide not to sell this stock at $8, you have not made this loss. That's why it's called unrealized loss. You have not made this loss. It is when you decide that, okay, I don't mind, I want to take the loss, and you decide to sell the stock at $8, that is when you make the loss. So if you see on your app, that's why the app is good. It tells you unrealized loss. It tells you this stock is red now. If you sell, this is what you're going to be making, right? This stock is green. If you sell, this is what you're going to be making. So when the stock is telling you it's red, hold it. Because if you check, there will always be a dip, there will be a bounce back. There will be a dip, there will be a bounce back. That is the way, if you check the graph, there will be a dip, there will be a bounce back. When it gets to that peak again, there will be a dip. That's the way the market works. When it's dipped, people will start buying again because it's reacting, it's demand and supply, right? It's demand and supply. When it gets to this peak, people want to take profit. Institution wants to take profit. Once they start taking profit, what happens? They push more sales to the market, right? They push more sales to the market. And because they push more sales to the market, what happens? The price would drop. There's a dip. So now that you know that, oh, if I sell, I'm going to be making a loss of $2, then hold it. Hold it. So that when there's a bounce back, you take you take your profit at that point. It's the same thing with a physical property. If you have a physical property today, Physical property, there's also times that the market will be low for physical property. If you decide that the market is low, oh, this house is supposed to be worth $300,000 right now, but because of the way the market is worth 290. You can decide to hold your property and not sell. It is when you sell it that is when you make that loss. If you don't sell, you don't make the loss. It's an unrealized, like it is not yet realized. Until you sell, that is when you make the loss. So when you see that there's a dip in your stock, don't sell. Just hold it for a while. It will bounce back. If it's a good stock, it will bounce back. And if you check the graph, that's what you see. Goes up, it dip, bounce back. There's a dip, it bounce back. So I hope I answered your question, sir. Okay, I'll take one more question before we go ahead into how do we actually start investing. You're welcome, sir. Thank you. I'll take one more question before we go into how do we start investing. Okay, this one is a good one. It says, how do I know when to rebalance my portfolio? How do I know when to rebalance my portfolio? Now, the first thing I want to ask is, what is a portfolio? What is a portfolio? A portfolio is like the combination of your assets, your stocks. So if you have more than one stock, you have 2, 3, 4, 5 from different companies, different ETFs, that forms your portfolio. Now, when do you know when to rebalance it? You know when to rebalance it based on your investment goals, right? Based on your investment goals. When you look at your investment goals for this year, if your investment goals for this year is I want to do 50% of my portfolio in growth stock. Growth stock are the ones that appreciate, right? And the stock that appreciate as that they don't pay dividends, so they pump all their money back into the company, and because of that, the prices of the stock would grow. You want to 50% into growth stock, and you say, okay, maybe 30% into dividend stocks, maybe 20% into individual stock. Maybe 20% into individual stocks, right? This is your goal, your investment goal for 2026, right? Now, what you will now know that it's time to rebalance your portfolio when you go into your portfolio and you're seeing that, number one, your growth stock is shooting to 70%, right? Remember, your goal is for growth stock is 50%, right? But you're seeing in your portfolio, your growth stock is shooting to 70%. Then you know it's time to rebalance your portfolio because your portfolio is no longer meeting your goals. It's that you rewrite your goals to meet your portfolio or you rebalance your portfolio. Another time another time for you to look at rebalancing your portfolio is when you're at another stage of life. So let's say you were single before, but now you are now married. That means now have responsibility. Now it's time for you to rebalance your portfolio because the type of risk you can take when you're single will be different from the type of risk you want to take when you're married, when you have responsibilities, right? It's different. So that's when you're not at another stage of life. That is when you look at, oh, it's time for me to rebalance my portfolio. Maybe you've now started having kids. That means more responsibility. It's time for me to rebalance my portfolio. Or you're getting towards retirement. You're getting to an age where you cannot take high risk investment again. Then you know it's time for you to rebalance your portfolio. But it is always good that every year, at least once a year, take a look at what's in your portfolio. How are they doing? Take a look at it and see, does this thing meet my investment goals? If the answer is yes, then fine. If the answer is they don't meet my investment goals, then you can look for how to rebalance. And how do you rebalance? Rebalancing means that maybe you have to sell some stocks off and buy some other stocks into your portfolio. So for this person that says, oh, I want 50% of my portfolio to be growth, right? And right now they are on 70% growth. What do? They sell 20% off from their growth and reposition it into dividends and individual stocks. That is how you rebalance your portfolio. Thank you for joining us this evening. We've just been doing question and answers about the stock markets. Right now, we're going to start talking about how do you start investing in the stock market with $10, $5, $50, 1 million, 1,000. If you have questions, you can leave it in the chat or you can request to come up to ask your question. I'm not sure how to bring this person down. I'm not sure how to bring Shine down um, on Instagram. So yeah. So this evening, like I said, we want to talk about investing in the stock market. Investing in the stock market with any amount that you have, no matter how big, no matter how small, right? Starting from that very first place. So when you want to start investing in the stock market, the first thing you want to ask yourself is, why do I want to invest in the stock market? Why do I want to invest in the stock market? That's the first thing you want to ask yourself, right? And there are so many reasons. There are majorly two reasons why you want to invest in the stock market. Two reasons why you want to invest in the stock market. Reason number one is you want to invest for growth. You want to invest so that your capital would appreciate in the market. You want fast growth. You want your money to grow as fast as possible. That's your number one reason. Number two reason is you want income. Income is dividends. You want something to come to you every month. You want a payment to come to you every month. You want payments to come to you every quarter. That is you investing for income purposes. Now, if you have determined you want growth, you're going to be buying different stocks or different ETFs. If you have decided that you want income, on the other hand, you're going to be buying different stocks. So that is why the first thing you need to do is, why am I going into the market? Because for somebody that is going into the market for income, for instance, and the person goes to buy majorly growth stocks, what happens? That person would not get income. And what would happen? The person would panic sell because it's not meeting their goal. It's not meeting their goal. It's not meeting the reason why they went into the market in the first place. So that is why it's good for you to determine, do I want income? Do I want growth? Now, as you're going into the stock market, it's good for you to have a mixture of both because it helps your portfolio to be balanced a bit, right? It's good for you to have income and growth. But if you're going for growth, you can now say, oh, my growth portfolio will be 80%, my income will be 20%. But if you're going for income, you can say my income will be 80%, my growth will be 20%, right? Mixture of both in your portfolio. Now that you know the reason you're going into the stock market, the next thing you want to do is you want to commit, what amount am I going to start with? These are the foundation you're going to be laying before you even go to download that app, right? What amount am I going to be investing in the stock market? Now, I used to say start with any amount. I know, but you still need to know an amount you want to go with. And the way I tell you to calculate what amount you want to go in with is you're going to do a reverse engineering. You can say, okay, I have 20 years in the market. Maybe I want to invest for my retirement, right? I have 20 years before retirement. You can say, and I want to retire with $1 million. I want to have invested $1 million in these 20 years, right? $1 million in 20 years is what I want to have invested in the market. Now, what you are going to do is you're going to say $1 million. Remember that my goal is to invest $1 million in 20 years, divided by 20. $1 million divided by 20. That will give me $5,000 per year. Right? That means I need to invest $5,000 every year. Now, $5,000 every year might be much, but I can break it down into month. I can break it down into day. So what I'm going to do is $5,000 every year divided by 12. 5,000 divided by 12. 12 divided by 50, that's 4, right? Am I right? Yeah, 48. Yes, 48. That means I'm going to be doing about $400 every month. You can see the way I'm breaking it down. I'm going to be doing $400 every month. Now, $400 every month might still be much, right? I can break it down into week. We have 4 weeks in a month. That means I'll be doing $100 every week. 400 divided by 100. No, 400 divided by 4 weeks. That means I'll be doing $100 every week. Now, $100 might still be much. I can decide to break it down to 5 days that I work. That means I'm doing $20 every day. Now, The way I broke it down now, is it easy for the mind to conceive? Is it easy for the mind to say, oh, $20, that's just my 1 hour pay? So that means I'll be putting my 1 hour pay in the market every day, 5 days a week. And in 20 years, I would have invested $1 million. That means if you invest $20 every day, that would be my capital, not the returns, not the dividends, nothing. But my goal is to achieve $1 million, invest $1 million in 20 years. I break it down to the number of years. That means I need $5,000 every year. I break it down to months. I mean, I need $400 every month. I break it down to week. I need $100 every week. I break it down to days. I need $20 a day for 5 days a week to invest $20 every day. No, $20 5 days a week for 20 years will give me a capital of $1 million in 20 years. Now, do you have the $20 every day? Maybe not, but you're going to start with whatever you have, right? You're going to start with whatever you have, but you have it at the back of your mind that my goal is to do $20 every day for 20 years. Okay, so you can see, this is how you can even set your child up. So if you have a child that is 0-year-old today, or 2 years old, or 5 years old, just imagine that you're keeping $20 every day aside for this child for the next 20 years. By the time the child is 25, by the time the child is 20, the child already has $1 million in capital, not the dividends, not the returns on that money. Okay, so now that you know the amount you want to start investing with, remember we said we know the reason why we're going into the market, we know the amount we want to start investing with. Now, the next thing is for you to now decide, what app do I want to use for my investing? Because for you to invest in the stock market, you need a brokerage app. You need a brokerage app to be able to invest in the stock market. So what is a brokerage app? A brokerage app is what you use for investing. It's different from your bank account. It's different from your banking app. That is what connects you to the stock market. What is the stock market? The stock market is where investors, public companies go to list their stocks, requiring you and me to come and invest in them. They go there to list their stock and say, oh, I'm looking for investors. And you, as an investor, you go to the same stock market and say, oh, I'm an investor, I'm looking to invest in your company, right? And you buy the shares through your brokerage app. So what you're going to do is you're going to download the brokerage app from your Play Store. You're going to create a profile on the brokerage app. So what type of apps do we have? If you're in Canada, you can start with World Simple. World Simple is beginner friendly. If you need options, you can do Quest Trade. All these are beginner friendly apps. If you're in the US, Fidelity is there, Robinhood is there. Download it, create a profile on it. If you're in UK, Trading 212. If you're in Africa, Bamboo is there, Chaka is there, Trove is there. Download this app and create your profile on the app. So when I say create your profile, you're going to put your name, your address, and the likes. And you're going to put your social insurance number or your tax identification number. Your social insurance number or your tax identification number. You're going to be needing it on this app. And the reason you need your social insurance number is because investing is a taxable item. You're going to be making money from investing. So the government needs to tax you. And how would they tax you without your social insurance number or your tax identification number? That is why you need it. Most people get stuck at that point. That is why you need it. So you've downloaded the app, you've created your profile. Step number 1 is done. Do we have questions about that? Do we have questions about that? If you can help me like the live, I would really appreciate, so we can get more people into the room. If you have questions, you can drop it in the chat. Okay. Now that we've created our profile, we've downloaded the app, we've created our profile, the next thing we want to do is we want to choose an account we want to use to invest, right? When you download this app, you create your profile. Thank you so much for the like, Zizda. Zap 57. Thank you for the like. So once you download the app, you want to choose an account. Once you create this, open this app, you're going to see different types of accounts in this app. But you need to choose an account you want to use to invest. So as a beginner or somebody that have not exhausted their taxable account, a non-taxable account, you want to start with a non-taxable account or a tax-deferred account. So a non-taxable account is an account that you don't pay taxes on your return. You've invested $10,000, you make a $1,000 gain, you don't pay taxes on that $1,000 you've made because you use a non-taxable account. A tax-deferred account, on the other hand, is an account that you defer the taxes to a future date. I've made $1,000 now. I am not going to pay the taxes on that $1,000 until the future, maybe when I retire, when I want to start withdrawing from that account. Those are the two. Then we have the taxable account. Taxable account is, as you're making the money, they are doing what? They are taking your taxes from you. Okay? Now, those are the types of accounts that are on that app. So now, as you're just starting, you want to start with a non-taxable account so that you're able to retain more funds to yourself. You're able to retain more funds, right? By using a non-taxable account. And there are so many different types of non-taxable accounts depending on the country you're in. If you're in Canada, we have tax-free savings account, TFSA. If you're in the US, you have Roth IRA. If you're in the UK, you have stock and shares ISA. Africa, you do not have any account, so you use your regular account, your regular investing account. So these are the types of accounts you can use. But when you move your money into this account, you do not stop at that point because you need to actually invest the money. What most people do is, oh, I've moved my money to my TFSA account, my money is breathing in my TFSA account, and they do nothing. But if you have done that, you have done yourself a disservice because you have only treated your tax-free savings account as a regular savings account because you need to invest it. And that is what takes us to step 3, which is you actually investing in the stock market. Now, when you say you want to invest in the stock market, what are you looking for? You want to either buy a stock or you want to buy an ETF. ETF is exchange traded fund. So you want to buy a stock or you want to buy an ETF. So what is a stock? A stock is you investing in a particular company. One company. I want to invest in a company that produces this pencil. Me investing in just one company is me buying the stock of a company. An ETF, on the other hand, is me investing in a basket of funds. All these buttons in this remote represent companies. All these buttons in this remote represent different companies. That is me investing in an ETF. This is a basket of funds, basket of different companies. All these buttons you're seeing, they represent one company or the other. Okay. Now, why is it good as a beginner? Should I buy stocks? Should I buy ETF? Because I know that's the question that you're asking yourself. Should I buy stocks or should I buy ETF? As a beginner, it's good for you to start with an ETF. And I will tell you why. So as a beginner, you don't really know what the market is. You don't know how to read the charts. You don't understand what to look out for in the market. So, but if you buy a basket, right, a basket of funds, what happened? Number one, you have lowered your risk. Instead of investing in just this one pencil, just this one company, you've decided to buy a basket that has different companies in it. So what have you done? You have lowered your risk because you are now having this bunch instead of just this one by buying an ETF. Number two, you have diversified your risk. You have successfully spread your risk among all these companies. So what happens if this company, if this button is bad, all these other ones will hold your fund for you. These other ones will hold your fund for you. That's you investing in a basket of fund. These other ones will hold your fund. If you have questions, you can leave it in the chat. These other ones will hold your fund for you, pending when this recovers. Or if this does not recover, at some point, they're going to take it off and bring in another one. That's you diversifying your risk. You're spreading your risk because it's possible that this company is into technology, this one is into utility, this one is into telecom, this one is into hospitality, right? So if technology is not doing well, hospitality is doing well, utility is doing well, your stock will still be performing well. Number three reason is good for you to start with an ETF as a beginner is because somebody is actively managing this fund, which means somebody's 9 to 5, they wake up, they go to their 9 to 5, is for them to look at this portfolio, this fund, and say, oh, this company is not performing to expectation. Let's take it out of this basket and bring another company into this basket. Oh, this company is not performing up to expectation. Take it out of this basket. Let's put another company in this basket. Somebody is actively doing it. But you are a beginner, you don't really know what to look out for. But this other person that is actively managing this portfolio is a professional. That is what they are paid for. So they are already, somebody, a third party is looking at what you're investing in. And finally, you're going to be paying one fee for this portfolio. So once, if they say this thing is $100, that means when you pay $100, you have everything in it. So that is why, as a beginner, it's good to start with an ETF, right? Unlike you just going blindly to buy stocks, especially if you're an individual. It's good for you to start with an ETF. Now, question you're asking now is, yes, if I buy an ETF, how do I make money from the markets? I've agreed to buy an ETF, but how do I really make money from the market? Right? You make money from the market by buying your stock at a lower price, holding it for a period of time. When the price increases, you sell. That is how you make money. We are buyers and sellers in the market as well. The only difference is we are not day traders. Day traders are the ones that they want to buy now, they want to sell, they want to buy, make their margins, sell. They are looking at the chart, they are looking at everything. But no, what we do is we buy stocks and ETF of good and reputable companies. We buy it, we hold it for a period of time. Once the price increases, we'll sell. We buy at the lower price, we wait for the price to increase, we sell at a higher price. That is how you make money from the stock market. Remember, I have said it that if you buy a stock for $10 and you're seeing it's showing you that, oh, you can right now, if you sell, you can sell at $30 and make a gain of $20. If you don't sell, you've not made that gain. You've not made the gain. Because a lot of people, what they do is we just buy and just be looking, just be looking. But it's always good for you to say, okay, I buy, maybe if I make 20%, I'm going to take small of my profits. I want to take a bit of my profits out of the market. Thanks you for the follow, most wanted. Right? You want to take a bit of profits out of the market and still leave your stock as they keep increasing. The profit you've taken, you can use it to buy another stock at the time that the price would reduce. Remember, I said when the price, it gets to a point, the price would shoot up. At some point, it gets to a peak, it comes down again because people, institution will take profits. Institution will take profits. It is not your money that will make the price fall. But when institutions, people that have invested billions, institutions that have invested billions into the market are taking profits, the price will drop. You buy at a low price again, you hold it for a period of time, and you sell when the market does what? When the market goes up again. Now, when you are looking at the stock market, you might be wondering, yes, I've heard that a lot of people make losses in the market. It's true. People do make loss from the market. But how will you be different from those people that make loss from the market? Number one, you have to build a mindset. Investing is a mindset, right? If I say I'm not going to take loss from the market, I'm not taking loss. Even if I buy today, maybe I didn't do my analysis well and I bought a wrong stock. I don't want to take loss if the price is going down. The only thing that will make me take loss is maybe I now know that, oh, this stock can never recover again. And I'll say, okay, let me take my loss and move on, right? So before you buy, you're going to look at the company. What's the health of this company? What's their revenue? What's their debt ratio? These are the things you look out for before you buy. You're not buying based on emotion. You're not buying because you've seen three people on the internet say, oh, buy this stock, it's going to do well. You're not buying because of that. You're buying because you've done your due diligence and you're sure that this stock is a good stock to buy with your hard-earned money, right? You do your due diligence and you're sure that this stock is a good stock for you to buy and put in your portfolio. And if you buy good stock, if you check the graph of good stocks you want to buy, 12-month chart, 5 years chart, 10 years chart, you would see that they will always make money. If you check the chart 1 year, 5 years, 10 years, and the company is not making money, why are you putting your money there? A company that's not made money in 1 year, in 5 years, in 10 years, why do you want to put your money there? You don't want to put your money there, right? So you check the chart. If these companies are making money 1 year, 5 years, 10 years, then you know it's a good company. You put your money there. Those are not the things I've told you. You check the debt ratio, you check the revenue, you check the book value. What are the things? Those are the fundamentals you check before you put your money in the market. Now, the next question you are asking right now is, what's rate of risk? How am I sure that I can even make money from the market, right? How am I sure that I can make money from the markets? So let's do our investment calculator. I love to use investment calculator a lot. So just go to Google, put in investment calculator. A lot will come up. Investment calculator. Investment. Investment calculator. So you can just pick anyone that comes up, right? So I'm going to be using the sample of that person that was doing $20 every day for 20 years. So that means every month we're doing $400 every month. Yes. $20 every day is 5 days a month. So $20, $400 every month. So we're going to start with $400. We are investing for 20 years. Remember, that's why we're able to achieve our $1 million capital. Let's even use a 10% rate of return, because the most popular one, S&P 500, does about 10% return, right? Annually. And every month, we're going to be doing $400. $400. So at the end of 20 years, am I right? $400 starting with $400 additional contribution. I'm doing 20 years. Am I right? $5,000 every year. Oh, sorry. 10%. No. Annually, additional contribution at the end of the month. I'm doing 400. Yes, now this is what it's supposed to be now. I'm starting with 400. Yes, 20 years. My rate of return is this. Okay. Let me do 5,000. How did I get 5,000 per year? All right, let me see. $5,000 annually. Contribution is at the end. $400 every month. That's it. 20 years. I'm not getting the 1 million. How did I achieve that 1 million? Let me go back. $1 million divided by 20. Oh, sorry. This is 1. Sorry, it's not $5,000. Nobody did the calculation with me. It's not $5,000. It's about 500. It's $50,000 every year. Oh, no wonder I wasn't getting it here. Okay, so I'm using $400 every month. I'm contributing for 20 years at a 10% rate of return, and I'm doing $400 extra every month. So I'm starting with $400. I'm going to be doing every month 400 at a 10% rate of return. After 20 years, what do I have? And my total income would be $289,000. Let me just say $290,000. Now, what is my total interest for that 20 years? Remember, my total contribution is 96,000. What is my total interest for that 20 years? 20% rate of return annually. What would that give you? 20%. Remember the 10% rate of return. We went on with 290K. Our total contribution was 96,000. So let's now say you have stocks that are doing 20% rate of return annually. You'll be going home with $990,000. $990,000 is what you'll be going home with. Your contribution will still be $96,000. If you now have stocks that are doing maybe 30% return, which is possible, 30% return, your contribution is still $96,000, but you're going home with 3.498 million. That's about 3.5 million because of the interest rate. Because of the interest rate. Every other thing remains constant. It's just the interest rates that have changed between these three people. They started the same time. They started contributing the same amount, but the first person was doing at a 10% rate of return. Second person was doing 20% rate of return. Third person was doing 30% rate of return. And you can see the gap between the three. Person that is doing 10% is going with 290. Person that is doing with 30% is going with 3.49 million. Going home with 3.49 million. That's to tell you that your money can actually work very hard for you in the market. It all depends on how hard you want your money to work for you. If you want your money to just be doing jelenke, your money will definitely do, it will live the soft life. But if you want your money to also do what? To also work extra hard for you, it will also work extra hard for you. Right? It will also work extra hard for you. It all depends on what you want. All right? So do we have questions? Do we have questions? Okay. And how much do you use to start investing? Like how much can you start with? You can start with any amount you have. $1,000, put it in the market. $50, the market will accept it. $200, the market would not reject it. $10, the market would not reject it. So start with whatever amount, any amount you can comfortably afford. Start with it. That will be the foundation you're laying. As you lay the foundation, as you begin to grow your money. When we started the live today, Shine came on live, Shine 2256 came on live, and she said she has started. She has gotten her first dividend. And I asked her, how do you feel getting your first dividend? She said she was just imagining, do you mean that this money is for me? But if she had not started, she wouldn't have gotten that first dividend. She wouldn't have gotten that first dividend if she had not started. Right? So start with whatever amount you have. Just like I said, start with $20, start with $10 every day. You can tell yourself, I'm just going to start with my 1 hour pay. If you're earning hour, even if you're earning salary, you're earning per month, right? Divide it. There's a way you can divide it and still get, okay, this is what I'm earning per hour, right? You can start with that 1 hour pay and say, okay, my 1 hour pay is $20. I'm going to be putting every day 1 hour pay, $20 in the market and buy stock, because you can buy fraction. You don't need to have the amount, the stock, the price the stock is being sold for you to be able to buy in the market. You can buy, oh, the stock is selling for $50, but I have only $20 to invest. You can buy a fraction of that stock. Another time, you put another $20 in the market, you buy a fraction of the stock. And before you know it, your money is already growing in the market. Before you know it, your money is what? Is growing in the market. And you're making your money work for you. Because when you put that $2, that $10, $1 million in the market, any return that somebody makes, that somebody that puts 1 billion in the market, if you bought the same stock, if the stock is doing 10%, the same return, you also get 10% return on the amount you put on the market. So just imagine somebody that is investing maybe $10 every day. every day. That means at the end of every week, let's even say $10 every week. At the end of 52 weeks, the person would have invested $520. 52 weeks is in a year. That's at the end of 12 months. That's $520. So let's say they invest in a stock that does 10% return. That means the person would have made about $52. $52 during that 1 year. And remember that this person was investing every week. It's possible that the person has dollar cost averaging because the person will buy at different rates. So it's possible that the person's rate is even lower. The person might make more than $52. The person might make less than $52, depending on how the dollar cost averaging works for that person. Because the person is buying every week at different rates. So it's going to be like an average rate. What's the average rate of your investment? Right? But let's even say the person is buying at the same rate. You've done 52 weeks, $10 every week. That's $520. In a stock that has done maybe 10% for that year, you would have made about $52. And let's now say the stock did 20% that year. On your $520, you would have made about $104. You didn't have to lift your finger. You didn't have to do an extra job. All you did was just to put your money in the market, and your money did what? Or your money did all the work for you. So start with whatever amount you have. Do we have questions? Do we have questions? Okay. So what did we learn in today's class? I'm going to do a recap. What did we learn in today's class? Today we looked at we started with, why do you want to go into the market? Are you going for income? Are you going for income? Are you going for growth? Why are you going? And we started with how much do I want to invest? We started with your end goal. You break it down to your daily, your weekly, right? And then we moved on to, you need to download the app for you to actually start this journey. Download your brokerage app. You choose an account you want to start investing in, and you want to decide, do I want to start investing in individual stocks, or do I want to start investing in in exchange traded fund, which is ETF? Which one do I want to start investing in? And if your goal is even to have real estate, oh, I want to have real estate, I want to get that rental income, you can still achieve the same goal in the stock market. I like to preach it. You can achieve that same goal in the stock market without having the huge down payment, without having that best credit score, without considering that you have debt on you. You can achieve it because what you're going to be buying is, you're going to be buying the real estate investment trust. You're going to be investing in real estate investment trust. And those people, what they do is, all they're investing in, what they specialize in is real estate investment. So you'll still be able to achieve that dream, just that you'll be achieving it through the stock market instead of you having a physical property. And it helps you to be able to achieve your dream faster. Before you want to get the down payment, you want to save for that down payment. Maybe it might take you 2 years, 3 years for you to save that down payment. Or you can achieve the goal of you getting rental income in form of dividends from the stock market by investing in real estate investment trust. And you start with whatever amount you have. It doesn't care about your credit score. It doesn't care about the debt you have. All it cares about is you investing in them and you getting your money paid to you in form of dividend. Okay, so I hope we learned something in today's class. Normally, I teach investing. I come on live evenings like this and I teach investing. I talk generally about money. I have a community where I teach. This is just a surface. If you go with this, if you decide to run with this today, I guarantee you that you'll still be able to invest. However, if you want to seek knowledge, you want to learn that, you want to dive deep into it, you want to understand how to understand how to read the chart, you want to know, okay, before I put my money in this investment, I need to be sure that it's worth it, right? Then you can join my class. I have masterclass coming up next Saturday. I have a masterclass coming up next Saturday. In this masterclass, what I'm going to be teaching you is everything you need to know about the stock market, right? Everything you need to know about the stock market. How do you read the chart? How do you go into profit and loss account and see, oh, this company, is it really what they are saying? Because you're seeing the surface, what's at the back end. How do you go to that back end to see what's at the back end? These are the things that are in this class. And in this class as well, I will give you different ETFs, exchange traded fund. Aside from individual stocks, I give you a list of individual stocks that you can research into. I give you 8 ETFs that has done a minimum of 36% in the last 3 years. A minimum of 36%, right? When you look at the person that did 10% and the person that did 30%, you can see the difference. They were doing the same amount for the same number of years, but the only difference is the returns, the rate of return was the difference that made one to go on with 290 and the other person is going on with 3.49 million, right? So if you want all this, you can join my next masterclass. It's coming up next week, Saturday. The link is in my bio. So if you want to get it, all you need to do is just to click on my profile picture on TikTok. Once you click on the profile picture, it's going to pop up. You'll see like a board that shows my profile picture again. Click on it and you see a link in my bio that leads you to my stand store for you to be able to get it from my stand store. If you want a pre-recorded class, the pre-recorded class is also there, right? That pre-recorded class is you watch it yourself. It's very practical. Like you can pause it, you can rewind, you can do. And once you're done with this, you can join our community. You can join our WhatsApp community where you can go ahead with further help. Like you have questions, you have access to me and my team, you have access to us, you can ask your questions. There are like-minded people in this community that are also investors on the same journey with you, right? So that you can join the like minds. So, like I said, if you want to join, the link is in my bio. If you have questions before we go this evening, let me know if you have questions. On YouTube, if you want to, on Instagram, if you want to join, send the word live, LIVE, and I will send you the link. On YouTube, if you want to join, I'm going to drop the link for you to use to make your purchases to join the next masterclass. Like I said, you're going to be getting a lot of things and you're going to see testimonials on this. Even if you go to the website, you see testimonials of people. I'm glad that Shine was here today. At least we were able to listen to her where she said she already got her first dividend. What does that mean? She has started her journey already. Um, okay, I'm trying to get the link for people in YouTube to be able to make their purchases. So do we have questions? Oh, this life is free, so you can ask your questions and I will not charge you for your questions. And if you want a one-on-one session, there's a link there as well. Maybe you don't like group class, you want a one-on-one session, you can get it on the link there as well. That's for the YouTube people. Okay. I'm not seeing any questions come in. Do you have questions? It might not be finance related. I know I put digital products here, but we didn't talk about digital products today. Digital products is you creating some money from some digital stuff. We did digital product the last time I was live, but today we didn't do digital products. Maybe tomorrow we might split the time again, use some time for digital products, use some time to talk about investing. That's if I'm live. I must sparkle. You don't wear wig now. Thank you, ma. How are you doing, ma? Yeah. Okay. So questions are not coming in. Do we all understand what we did in class today? Thank you so much, ma. It's my birthday gift. My birthday was on Wednesday. So I decided to buy something for myself. It's not only investing, investing, investing. NSE. I asked you where I will buy them. What's NSE? Oh, thank you so much, ma. What's is the ticker symbol NSE? Real oh sorry, that's AI. I'm not sure what's NSE. Oh, I bought it from Nigeria actually. I can send the lady's handle to you. I bought it from Nigeria. Ah. Oh, Nigerian Stock Exchange. Oh, thank you so much, Toby. So, um, okay, yeah, okay. So, do we have questions though before we call it a night? Let's try. Okay, so I'm ending this one.